Why is Brent crude dropping today after Iran missiles? Is this a crude oil supply shock or a demand fear freefall? Our oil forecast this week centers on the 91.96 support zone and the 97.01 resistance ceiling. Right now, Brent crude is in freefall. Price has dropped to 93.09, accelerating lower after Iran fired missiles directly at Israel. That sentence should send a chill down your spine, because logically, oil should be ripping higher. It's not. And that, right there, is the trap. There is one danger zone that can liquidate late longs in the next 24 hours, and one hidden opportunity that will separate the prepared from the wrecked. I'm going to show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, with specific entries, stops, and risk-reward ratios that you can screenshot right off the screen. Let's get your instant market verdict. The session bias on Brent is clear. We are fading rallies. On the daily, on the 5-hour, on the 1-hour, every short-term time frame is screaming strong sell. This is not a minor dip. Price has broken below the 93.50 support like it was nothing, and the momentum is accelerating. Monthly trends still read strong buy, and weekly is neutral, so this is a deep correction within a larger bull cycle. But corrections can do serious damage if you're on the wrong side. The single invalidation level that flips everything is 97.01. Write this number down, 97.01. If we get a daily close back above that resistance, the bearish structure resets, and this entire freefall becomes a failed breakdown. Until then, the path of least resistance is lower. Here's what matters about where the herd is positioned. They're overwhelmingly long. Speculative positioning had been building for weeks on geopolitical fear, expecting any Iran escalation to explode crude. Those longs are now trapped above 95, and every tick lower triggers more stop-loss selling. That's jet fuel for a liquidation cascade. The market isn't inefficient. It's doing exactly what it does, punishing the consensus trade. Watch the stop run below 93.00. That's the fuse. Let's walk the charts now. We are going top-down, weekly, daily, 4-hour, and 60-minute, and I'll reference the exact moving averages and momentum readings so you understand the architecture beneath this drop. On the weekly, crude remains above the 200-week moving average, which sits way down at 83.62. That's the macro floor. We are miles above it, so structurally the long-term trend is intact. The weekly moving averages are still bullishly stacked. The 50-week is 97.66, the 100-week is 91.99. Notice that the 100-week moving average is virtually identical to the key support we are all watching at 91.96. That is not a coincidence. That convergence of the 100-week MA and the horizontal support creates a magnetic zone. When price approaches that area, expect massive reaction. Now drop to the daily. This is where the damage is visible. The 5-day moving average at 94.80 has turned into dynamic resistance, sloping sharply lower. The 10-day at 96.40 is well overhead. The 20-day at 98.20 capped the last rally perfectly, and price is now more than $5 below it. When the 5 and 10 cross below the 20, that's a classic death cross acceleration pattern, and it's happening right now. The daily RSI is at 41 and falling, nowhere near oversold yet, which means there's room for further downside before any meaningful bounce. The MACD on the daily is deeply negative, and the histogram is printing lower lows. No hidden divergence here, pure bearish momentum. The bull-bear reading of -5.4 confirms net bearish pressure across the complex. This is not a market that wants to rally. It wants to find a lower floor. On the 4-hour, we get the execution details. Price has carved a beautiful series of lower highs and lower lows, with each bounce sold viciously. The 20-period moving average on the 4-hour is at 95.10, acting as a sloping ceiling. Every single attempt to push above it over the last 3 sessions has failed, and that failure keeps attracting fresh shorts. The MACD on the 4-hour, here's what most traders miss. You see that histogram ticking slightly higher while price makes a lower low. That is the earliest seed of a potential bullish divergence, but it's not confirmed. It's a whisper, not a scream. If price continues dropping and the MACD histogram starts making higher lows, that would be the first crack in the bearish armor. Right now, though, momentum is still accelerating downward, and divergence without confirmation is just hope. The stochastic on the 4-hour is buried at 28, leaning oversold, but oversold in a strong trend can stay oversold for days. Do not try to catch this knife because you see a low stochastic number on the 60-minute. We are watching the immediate supply zone. Price is consolidating just below the broken support of 93.50. That level is now resistance. Any pop back up to test 93.50 and fail will be a gift for short entries. The 1-hour RSI is at 38, and every small bounce is getting slapped down at the 20-period moving average, currently around 93.65. That tells you sellers are active intraday. Until the 1-hour closes above 94.00 with conviction, the microstructure is bearish. Now we connect the dots across assets, because oil never moves in isolation. Gold, oil, and bonds today are sending one message, and that message is a demand warning wrapped in a geopolitics mirage. Gold is rallying, a straight fear bid. Bonds are catching a bid too, yields dropping, which screams growth scare. Oil, meanwhile, is plunging. How do you reconcile that? The market is telling you that the Iran-Israel headline is not being treated as a supply disruption event. The smart money is pricing a rapid diplomatic cage. Saudi Arabia and the Trump administration are working furiously to stop Israeli retaliation before it escalates to the Strait of Hormuz. That back-channel intervention is the invisible story behind the freefall. Yesterday's missile salvo was likely a symbolic show of force that both sides will now use as a face-saving exit. If that holds, not a single barrel of crude leaves the market. The war premium that had been baked in over the past month is being unwound in real time. The cross-linkage with equities matters too. The S&P 500 has been shaky, and a growth slowdown narrative fits perfectly with oil demand destruction fears. If the VIX spikes further and equities break key gamma levels, that risk-off wave will drag crude even lower, regardless of geopolitics. For the next 1 to 2 weeks, my directional lean is bearish while price stays below 97.01. The target is a full test of the 91.96 support, and if that fails, a capitulation move into 89.00 is highly probable. The event that invalidates this lean is a daily close above 97.01. That would signal the geopolitical bid is back, and the bear trap gets sprung. Do you think oil breaks 91.96 this week? Comment yes or no right now. I'm tracking consensus across the channel. Type it in. Let's get into the trade setups. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm about to hand you 3 strategies with exact prices, stops, and targets, and I'm putting them on the screen so you can screenshot them right now. No guesswork. Strategy 1. This is the sniper, your conservative, high probability setup. We sell a retest of the broken support turned resistance at 93.50. Here's the exact trigger. Wait for a 1-hour candle to close below 93.50 after a rally back up to test that level. That shows sellers are defending the zone. Entry on the close below 93.50. Your stop loss goes above the 5-day moving average at 94.80. That's a logical structural level. If price gets back above the 5-day, the short-term momentum shifts. That gives you a stop of roughly $1.30, depending on exact fill. Take profit 1 is 91.96, which is the convergence of horizontal support and the 100-week moving average. That's roughly $1.50 below entry. Take profit 2 is 89.00, the major level where buyers will step in aggressively. On this setup, your risk-reward on the first target alone is better than 1 to 1, and if runner hits TP2, you're looking at a ratio near 1 to 3. Void this setup if we get a daily close above 95.00, which would indicate buying pressure is overwhelming the 5-day resistance prematurely. The sniper, conservative, entry, 93.50, 1H close below after retest, stop loss, 94.80 take profit 1, 91.96 take profit 2, 89.00 risk, reward. 1:3 are invalidation. Void if daily close above 95.00. Strategy 2, for the active trader. This is the momentum continuation play. We sell a break of the intraday support at 93.00. That's the psychological round number and a shelf of recent lows. Entry on a 15-minute candle close below 93.00, ideally with increasing volume. Stop loss goes at 93.60, just above today's session high. That's a tight 60-cent stop. Take profit 1 is again 91.96. Once that hits, move your stop to break even, and let the runner target 89.00. You also have the option to use a trailing stop of 20 cents behind price once TP1 is hit, to capture a potential full extension. The logic here is that the break of 93.00 opens the trapdoor, and momentum algos will pile on. A clean breakdown should not revisit 93.60 quickly. If it does, you're out with a small loss. Type your Brent crude range for tomorrow in the comments now. Let's see who's aligned. I read them to the active trader, standard, entry, 93.00, 15M close below, stop loss, 93.60 take profit 1, 91.96 take profit 2, 89.00 risk, reward. 1:5 on runner invalidation. Void if price reclaims 93.60 within 30-minute. Strategy 3, the aggressor. This is the high-risk, high-reward countertrend fade. Only for those who can lose small and manage risk aggressively. The play is along at the 91.96 support zone. Entry on a daily touch and a 4-hour bullish rejection candle. A long lower wick, a piercing pattern, or a strong green engulfing at that level. Stops go tight at 91.80, just 16 cents below the zone, because if 91.96 fails, the floor gives way and a cascade toward 89.00 is almost guaranteed. Targets are 93.50 and then 94.80, the old support now resistance. This is a mean reversion trade betting that the 100-week moving average holds on first test. Risk is 16 cents, reward could be $1.50 to $2.50, extremely asymmetric. But the success rate is lower, and you must not marry the trade. If the 4-hour candle closes below 91.80, you're out instantly. No negotiation to the aggressor, high risk, entry, 91.96, for H bullish rejection candle, stop loss, 91.80 take profit 1, 93.50 take profit 2, 94.80 risk, air reward, 1:10 a plus invalidation, void if 4H candle closes below 91.80 risk management pulse, never risk more than 1 to 2% per trade. No positions through high-impact news events like sudden geopolitical headlines or inventory reports. Stops are non-negotiable. This is how you survive to trade the next big move. The market will always be here. Your capital must be too. Here's the close and your retention loop. The single most critical level for the next session is 91.96. If that level breaks with volume, oil will enter a liquidation freefall toward 89.00, and the entire macro narrative shifts. If it holds and prints a clear rejection, we could see a violent short squeeze back toward 97.01. That's the boundary of the battlefield. Tomorrow, I'll be watching the S&P 500 gamma structure and whether the VIX confirms this risk-off wave, because oil and equities are now ticking together in a demand-fear feedback loop. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. Trade smart.